Hello and welcome. In this video we will talk about a topic in the field of banking or bank steering. We will take a closer look at interest risk management in banking. In particular, we will examine the methods, techniques and most common financial instruments to perform interest rate risk management in banking. Alright then, let's emphasize the common methods used by banks to mitigate the impact of interest rate fluctuations by starting with asset liability management, or ALM. Banks perform ALM to match the maturity and interest rate characteristics of their assets and liabilities. They analyze the interest rate sensitivity of their balance sheet, including loans, deposits, and other financial instruments. By ensuring a proper balance between the duration and repricing of their assets and liabilities, banks can minimize the potential impact of interest rate changes. Or in other words, ALM aims to ensure that the bank's assets and liabilities are properly aligned in terms of their maturities, repricing characteristics, cash flows, and risk profiles. On this channel you will find another video that delves more into detail of ALM, in case you are interested. Whereas ALM is the overall framework, banks utilize sophisticated interest rate risk models to quantify and measure interest rate risk. These models incorporate various factors and assumptions to estimate the potential impact of interest rate changes on a bank's balance sheet, income, and capital. By using such models, banks can make informed decisions about their risk exposure and optimize their risk mitigation strategies. The models are deployed taking into account different circumstances and especially market environments. Therefore, banks closely monitor economic indicators, market trends, and forecasts related to interest rates. By staying informed about economic conditions and interest rate expectations, banks can make proactive decisions and adjust their risk management strategies accordingly. This includes analyzing factors such as inflation, central bank policies, and macroeconomic indicators that influence interest rates. Different market environments can be simulated in stress testing activities. Banks conduct stress tests to assess the potential impact of adverse scenarios, including changes in interest rates. These tests evaluate how a bank's balance sheet, income, and capital would be affected under different interest rate scenarios. Stress testing helps banks identify vulnerabilities and adjust their risk management strategies accordingly. What measures can be carried out to mitigate the risk involved? Generally speaking, diversified portfolios are less prone to entail losses in times of stress. Banks diversify their asset and liability portfolios to reduce interest rate risk. By holding a mix of assets with varying maturities, interest rate repricing schedules, and interest rate sensitivities, banks can offset the impact of interest rate changes. Similarly, diversifying funding sources and customer deposits across different maturities and interest rate structures help to manage interest rate risk. As well as hedging activities can be performed, banks may use financial instruments such as interest rate swaps, futures, options, or so-called caps and floors to hedge against interest rate risk. These derivatives allow banks to offset potential losses by taking positions that are inversely correlated to the changes in interest rates. As mentioned momentarily, banks may enter into interest rate swaps to exchange fixed rate payments for floating rate payments, thereby reducing their exposure to interest rate fluctuations. Generally speaking, interest rate swaps are agreements between two parties to exchange fixed and floating interest rate cash flows based on a notional principal amount. The notional amount is the face value of a security. In the realm of derivatives, it is the reference amount upon which the calculations and payments of the respective contract. The parties agree to swap interest payments, with one party paying a fixed rate and the other paying a floating rate based on a reference rate such as the LIBOR or its soon-to-be replacement, the Secured Overnight Financing Rate, or SOFR. Interest rate swaps are widely used for hedging, managing cash flows, and altering interest rate exposures. Interest rate options. Interest rate options give the holder the right, but not the obligation, to buy or sell an underlying interest rate instrument at a predetermined price, the so-called strike price, on or before a specified date, expiration date. Common interest rate options include caps, floors, and swaptions, options on interest rate swaps. Forward rate agreements, or FRAs. Forward rate agreements are contracts between two parties to lock in a fixed interest rate for a future period on a specified notional amount. FRAs are used by banks to hedge against fluctuations in interest rates. Interest rate futures. On the contrary to FRAs, interest rate futures are standardized exchange-traded contracts that allow banks to hedge against future interest rate movements. Since these contracts are traded on futures exchanges and have predefined specifications, including contract size, maturity, and settlement procedures. Sooner or later this channel will have provided videos dedicated to each of those instruments. Stay tuned. Let's briefly wrap up. It's important to note that the specific strategies and techniques employed by banks may vary based on their size, complexity, and regulatory requirements. Additionally, banks are subject to various regulatory guidelines and capital adequacy standards, which influence their risk management practices related to interest rate risk. Thank you very much for your attention. We would be happy to see you again on this channel. Keep in touch.